Welcome to another edition of PowerOptions SwiftSkills. Today we're going to discuss unwinding a covered call. Again, this is Michael Chupka from PowerOptions, www.poweropt.com. Unwinding or rolling covered calls. As we know, covered calls can be a great way to generate consistent income, potentially rent out your stocks to help you lower the cost basis on core holdings, maybe give a little market hedge in case of an unexpected pullback. But at times, a stock may take off beyond your expectations and move above your short call strike price very quickly. And we attempt to generate income, selling maybe an out-of-the-money call on a long-term holding. But then in a few days, the stock might move up 5%, 7%, maybe a sudden jump of 10%, and we now risk assignment and, of course, a high buyback cost for our sold call. How can we unwind or roll our call to get more of that upside potential and avoid assignment? Now, in a covered call strategy, we are going to buy or already own shares of stock. We're going to sell a call against those shares to generate income. Take in a little premium. We lower the cost basis. We have that small market hedge, but now we do enter an obligation to deliver shares of those stock at the call strike price we sold. And it does cap the upside return. There are three main approaches in any covered call strategy, whether you already own the stock or you just bought the stock and are looking to do a buy rate position. Let's say on January 24th, 2019, I'm holding shares of StarBucks with a cost basis of about $64.75. Now, at that time, I could sell an in-the-money 15th of February expiration 62.5 call for $2.60. Well, most of that is intrinsic value, as I'm selling a call below the current stock price. I do have 35 cents of time premium. If I'm assigned, I'd get a 0.6% return for about 22 days, and I have a 4% downside protection. StarBucks could fall 4% before I start losing money on this position due to the $2.60 I took in. I can sell an at-the-money 15th of February 65 strike, 25 cents out of the money, but really just at the money, and we'll get 95 cents. Now that's all time value, and the max return if I'm assigned is 1.9%. We still have a reasonable 1.5% downside protection for 22 days. I'm more speculative. I can sell an out-of-the-money 15th of February 67.5 call for only 40 cents. That's all time value as well. It only offers me a 0.6% downside protection, but if the stock's above 67.5 and I get assigned, my max return is 4.9%. Now, as I mentioned, each call was 22 days out in time. We had the stock around January 24th, and we were going to sell a covered call. 8 days in, StarBucks exceeded expectations and is trading at $68.40, up $3.65, or 5.6%. 2 days to expiration on February 13th, StarBucks is currently at $70.50, up $5.75 from our cost basis of $64.75, or an 8.9% increase. All three of our potential covered call positions had a capped gain. We missed this upside movement because of the obligation of the short call. And of course, as the stock moved up, our call price increased in value. Even though we have a higher buyback cost, can it be rolled to get some of the missed profit? Well, yes, it can. But I have to ask myself, does it meet my goals? Now, is it wise to roll? Well, that depends on your personal trading plan, your goals for the trade, and your outlook for the stock going forward. If we had sold the in-the-money 62.5 call, looking for that small 0.6% return for a 22 day out time frame, we are likely looking to get assigned and just move on. Now, had we sold the 65, the at-the-money strike, I likely wanted a good premium with a good downside protection. I might have been hoping that 65 strike expired, and then I'd look to resell further out in time when we hit February 15th expiration. Had I sold the 67.5 out of the money, I was either hoping for appreciation and took in only a small premium for a small downside protection, or I was hoping it's going to expire worthless, sort of taking a dividend-like income on a monthly basis for the position. Now that we've hit this point, how do we look to unwind or roll? The process is simple. If I'm looking to roll a call, I'm going to buy to close my current call, and I'm looking to sell a higher strike call that is further out in time. Now, your broker likely has a roll feature. We could do this in one trade entry to make things easier, maybe even save a little bit of commissions. But what do I have to pay attention to when rolling a call? A common thought is that we should always look to roll for a credit, meaning the new call I select should have a premium that is essentially equal to or above the buyback cost of my current short call. Now, I know in this case the buyback cost is going to be high. Do I have to roll for a credit? Well, not necessarily, because rolling for a credit might mean I have to pick a new expiration cycle that's 3, 4, 5 months, maybe even 6 months out in time. And the new return I get might not match my trading plan if I'm forcing it to go 5 or 6 times my original planned trading time frame. Let's take our at-the-money call. Let's go back to January 4th, 2019. I'm holding StarBucks at $64.75. I sold to open the 15 February expiration 65 straight call for 95 cents. If I get assigned at 65, my return is 1.9% for that 22-day period. Here we are on February 13th, 2019, 2 days remaining to expiration, and as we saw, StarBucks is currently trading at $70.51. The buyback cost of our 65 call expiring in 2 days is $5.55, just a little bit above intrinsic value, roughly $5.51 in the money. We could take assignment because that max return of 1.9% should have matched my trading plan. Otherwise, I wouldn't have sold this particular call. Does it make sense to roll now that the buyback cost is high? Well, the answer is yes, it makes sense. If we want further upside, the new roll matches our trading plan, and we think the stock might increase higher. But now we have that dilemma. What strike and what month should we roll to? And do we have to roll for credit? And in most cases, we're just going to refer back to our trading plan. Initially, we took a just out of the money, sort of at the money call with a premium of 95 cents, which represented a 1.5% time value against the current stock price of $64.75. This offered a max return of 1.9% for 22 days. It's a ratio of about 8.6 with 1.9 divided by 22. Why is that important? Because the bare minimum roll should equal my return goal for my trading plan. Now, using the portfolio tools on PowerOptions and linking to the position analysis, I can see new returns for the rollout opportunities. We see here I could roll to the March 71 call. I'm only going to get 79 cents, so I have an adjusted net debit. The 95 cents we took in, the $5.55 buyback cost, and the new 79 cents of $3.81 debit. It's going to add to my cost basis. But the new max return, if assigned, is 3.6%, 1.7% higher than I could currently get for 16 days of time. That matches that ratio we just looked at from my original potential trading plan. However, the option premium is only 79 cents on a stock trading at $70.51. Might want to push that up higher to that 1.5% range that we saw with the initial covered call. In which case, go down a few lines, and I see here the 8th of March, 71 strike, 23 days out, a $1.02 premium, and a new potential assign of 3.9%. The total debit here is $3.58. That's going to increase my total cost basis because I'm not rolling for a credit. But I'm getting a new $1.02 premium, which is going to be 1.4% time value. My max return goes from 1.9% to a potential 3.9% in 23 days. So I'm keeping my ratio of about a 2% return for a 22 to 23 day time frame. I could lower the debit by rolling further out in time, going out maybe to April, which is 64 days out, but I have to make sure that the premium and the new percent return if assigned matches the ratios I want for my trading plan. Now, why don't we see any rolls for a credit? Well, the current SBUX series has weeklies out through March. Then we have April, June, and July. Then the 2020 January leaps, and the 2021 January leaps as well. No strikes at the 70 price or above offer a $5 or $5.50 premium in June or July. I'd have to go out to January 2020. The 70 strike call is trading at $6.65. This would be rolled for a credit. I'd actually lower my cost basis. But the max return if I'm assigned at 70 is only 9.2% for 338 days. This likely doesn't match my trading plan for the covered call portion of my portfolio. I'm trying to get maybe 1.8 or 2% every 22 days. I could still roll for a small credit going to the 2020 January 72.5 call at $5.60, but that would only be a 10.6% max return if I'm assigned for 338 days. Once again, not quite matching my trading plan for the covered call portion of my portfolio. In this scenario, I would likely roll to the 8th of March 71 call, 23 days out from today, $1.02 premium, a return of 3.9% for the new max return. This includes my buyback cost of $5.55. This keeps my initial time frame. I started the position 22 days out in time. I'm close to expiration. I'm going to roll it out close to the same time frame. I keep the strike just at the money or out of the money, following my trading plan, and I gain 2% from my current return for that extra 23 days, still in target. And this 102 premium is 1.45% time value, similar to the same percentage time value I received when we took in 95 cents on our cost basis of $64.75. Here we see the new position before and after. A current return of 1.8%. We let it go to expiration of 1.9%. This is shown on the left in red. I pay the $5.55 to close my 15th of February 65 strike call, roll up to just out of the money to the 8th of March 71 call to increase the return to 3.9% within the next 22 to 23 days. So when and how to roll? You can roll for a credit, but don't roll for a credit if it does not match your trading plan. If you're starting out just out of the money, of course, you may want to roll if the stock hits the next strike price. In our example, I may have rolled the 15th of February 65 call. When SBUX hit 67, I might have sold the March 1st 67.5 strike, and then maybe rolled again to the 15th of March expiration, maybe the 70 call or the 71, when SBUX approached $70 per share. But if and only if this matched my trading plan. Rolling can be easy. Now, aside from the concepts we talked about, you just saw the benefits of the PowerOptions Portfolio tool for managing your positions. As I track any position, covered calls, naked puts, collars, protected positions, married puts, and more, I can link to that position analysis to see which rollout opportunities match my trading plan with a new return. All of the math is done for me, and then I can link to see a side-by-side before and after picture before making my adjustments. Remember, you can put these tools to work for you at any time. If you haven't yet, you can take a no-risk, no credit card trial. Just go to www.powerop.com, enter your name and email address. This will give you access to the portfolio tools. plus the patented search tools for finding new positions, and much more. If you have any questions, of course, you can leave a comment here on our YouTube video. You can call us at 302-992-7971, or you can email us anytime to support@powerop.com. Thank you very much, and we'll see you next time for our next SwiftSkills presentation.